UnitedHealth just beat Wall Street's profit estimate by about 32%. Yes, you hear it right, 32%. On a company this size, the largest health insurer in America, that is an enormous surprise. And the stock reacted exactly how you would expect. Here is the thing, the single most important sentence spoken all day did not come from the press release or the big glossy numbers. It came from the chief financial officer of the call, and it was him telling everyone not to believe the most exciting story the beat seems to tell. I am Vikas, your host. This is what changed from VYNG Wink. We don't chase headlines, we explain what changed. Three lines plainly. Adjusted earning of $6.38 a share versus expectations near 485. A massive beat. And full year guidance raised for the second straight quarter. But the reality is, actually, this is real. Credible recovery from genuinely terrible 2025. But the beat came from pricing and discipline pushing against costs, and these are still elevated, not from the cost that is finally turning. So the company said, the CFO said that is that's the this story is not to believe. So the honest verdict is the turnaround is real. The cost trend victory the market is celebrating is the one thing management specifically refused to claim. Let me set the scene because it matters. 2025 was close to a near death experience for United Health. Medical costs ran wild. The company pulled its guidance mid-year. There was a leadership change. Justice Department cloud over its Medicare business, and one of its divisions, Optum Health. Actually, Optum Health lost about $3 billion in a single quarter at the end of the year. This was the biggest surprise for the market. So the bar coming into 2026 was the floor. Now, look at this quarter against that, and United Healthcare, the insurance arm, nearly doubled its operating earning year over year. Optum Health, the division that lost $3 billion in the fourth quarter, earned about $1.2 billion this quarter. $1.2 billion. That is a genuine broad based rebound. I don't want to take that away from them. It's the real thing. And it's why they have now raised their full year profit outlook three separate times. From above 1775 in January to above 1825 in spring to a range of 1950 to $20 today. Each of those raise was earned with delivered results. It's not the hope. So, where is the catch? It's in one number and how you read it. The medical care ratio, that's just the share of every premium dollar that gets paid back out as medical claims. That is the catch. If this is lower, it's better for the insurer. This quarter, it came in at 86.7%. Now, here is where you need to be very careful, and here is my one analogy for the whole episode. Think of that ratio like a student's report card. Compared to last year, the crisis quarter, the grade jumped from 89.4 to 86.7, almost 3 points better. Looks like the student figured out the subject. Okay. But compared it to the last quarter, just 3 months ago, and the ratio went the other way from 83.9 up to 86.7. It got nearly 3 points worse. So the honest read is not the student mastered the material. It's the student got a good grade,
this term by retaking last year's easiest test. That's the analogy for this entire report. The improvement is measured against a disaster and the actual direction of travel quarter to quarter. That is wrong way, in my opinion. And I'm not editorializing that direction. The company's own guidance, the company's own CFO, and the company's own guidance in their reports confirmed it. Their full year target for that ratio is 88.1%. But in the first half of the year, it's only run about 85.3. Do the arithmetic on what that means for the back half. To average 88.1 for the whole year, the second half ratio has to run somewhere around 90.9%. So management is quietly telling you costs get about 5.5 point worse into year end. At the very same time, it's raising the profit outlook. Both things are true. That's the quarter. So why does this distinction matter so much? Because the stock is not being priced for a well run company that cut costs with discipline. It's being priced, at least in part, for medical costs have finally turned the corner. And those are two very different futures. And this is the part I keep coming back to because the person who drew that line was not a skeptical analyst, it was the chief financial officer. On the company's own call, his words, these results are not a reflection of trend bending or coming under control, but rather our efforts to start pushing down what is already an elevated number. He also said medical costs remain elevated over historical levels. That's the finance chief looking at a 32% beat and telling you, don't mistake this, don't mistake this for the thing you are hoping it is. There is a second tell, and it's about growth. Revenue was essentially flat, about $112 billion, basically the same as a year ago. On the surface, flat and stable sounds fine for a giant, but underneath, United Healthcare is serving about 1.6 million fewer members than a year ago. It's deliberately walking away from unprofitable Medicare Advantage and Affordable Care Act enrollment. Revenue only looks flat because higher premiums are exactly filing the hole left by the members walking out the door. And again, the CFO's own framing, he said that price for members swap is not a good thing for the system long term. Now, here is the behavioral trap I want you to notice in yourself. When a beat is in this big, your brain wants to file the whole story under great quarter, cost fixed, moving on. But size and quality are different questions. This was a high quality beat, no doubt, but in the sense that it's repeated discipline, not a one-off gain. It was a lower quality signal in the sense that it does not tell you costs have inflected. And it leaned on the about $860 million of favorable reserves adjustments and some government payment timing that flattered the cash flow. Respect the beat, just don't let its size talk you out of reading what it's actually made of. So here is where we land. On the wing conviction scale, how much confidence today's evidence deserves. United Health moved to 6.4 out of 10, up from a post first quarter implied 5.5. It goes up because the recovery is proving real and durable, and three straight earned guidance raises is a genuine signal, but it's capped well short of high conviction because the market is paying for a cost trend inflection the company itself declined to claim. On a print with some flattering one offs into a full valuation near 31 times earnings. Again, it's not a buy or sell recommendation, just our assessment of how much confidence today's evidence deserves. Three questions the next quarter will answer. Number one, the second half medical care ratio, does it come in below that implied 90.9, which would mean the CFO was sandbagging and the inflection is actual real? Or does it run hot, confirming the beat was loaded into the first half? Number two, quality of earnings. Does the third quarter lean on another favorable reserve, that is release? And does conversions hold up once that the government payment timing washes out? Number three, how long can price keep covering for most uh, members who have lost membership before flat revenue simply turns negative? Here's the real story, not the headline. United Healthline genuinely climbed out of the hole it fell into last year, but it's being celebrated for a cost trend win its own finance chief refused to declare, while its guidance quietly says the hardest part of the year is still ahead. If you would like to explore every source and calculation behind today's analysis, you will find the complete research report at wing.io. Everything is sourced directly from United Health's filing because trust is not built by confidence, it's built by transparency. I'm Vikas. This has been what changed from Wing. We don't report everything, we report what changed. Clarity, not clutter.